Hi, welcome to Market in a Minute. We're still down here in Florida. It's absolutely gorgeous, a little warm. It's getting a little humid. I'm looking at the ocean and there is nobody out there today. Unlike the weekend, there is not a single boat in sight for miles and miles. We think we're at an important point in the emotion of the market cycle. So NVIDIA reports on Wednesday. We'll see what they have to say and how the market reacts to it. Should be a really strong quarter. So we think that at this point the emotion or speculation in the market is very high, and we think we're getting closer to kind of the end of this particular cycle. Stagflation. So I want to talk about that a little bit in this video. Stagflation, we think it's coming. Particularly in the summer months. We think the inflation rate's going to go higher and the economy is going to slow down. And then commodities, they've been on a big move. Incredible, some of the moves in the commodity space. Walk you through some of the things that we're thinking about there as well. So wealth management. Investors need to build their portfolios to be durable. So what that means is when markets fall, that they still hold up well. And to do that, you have to get the bad things out of your portfolio. So back in the day, I was at the Burger Funds. I ran the Burger Funds and was hired, replaced the senior portfolio manager there. And Bill Berger was retired, legendary investor. Bill Berger, he'd come into my office and he'd say, "Pat, pull the weeds. Make sure you don't have stuff in the portfolio that you don't like. Pull those weeds." So that's what we're doing currently. We're getting the weeds out of our portfolio. So if the market falls, we're adding to positions that we love. So just think in terms of this. If you really like a position in your portfolio, what if it was down 30%? Would you like it then? Would you buy more? If the answer is yes, emphatically yes, then that's a good position. Looking at the emotions of the market. So as you can see, it goes through these cycles. So at the bottom, investors are very depressed. They don't want to invest. They just want out. They want to stay away. They're panicking through this bear market. And then when the market moves, they don't believe it, right? When it goes back up, they don't believe it. How we design strategies is that we try to take the emotion out. So when everybody's euphoric here, we're watching our indicators to prevent us from having those big down moves. So as the market rolls over, we're getting more defensive. So this market cycle has been particularly frustrating. So it feels like we have a car full of Federal Reserve, members screaming, "Are we there yet?" They want to cut rates so badly, and it's causing somewhat of a problem in the overall markets. It's probably more euphoric than what it should be. So on Wednesday, when NVIDIA reports, they should report a very good quarter. When they have that report, we'll see how the market reacts to it. If the market doesn't react in a big way to a very strong quarter, then we know we're probably pretty close to the highs of the overall market. So we think we're kind of in this final phase here, and then as we go through the year, as the economy slows down and potentially the Fed can't cut rates because inflation stays high, then the market begins to roll over and the investor sentiment begins to turn negative. Now when you look at the S&P 500, this chart here, we came down, as we all know, held the 100-day moving average, bounced off of that, and have gone to a new high. So we think the support level, this is where we want to enter it on a short-term pullback, somewhere around 5,000. If it hold this level, we think that's a reasonable place to enter, about 5,000 on the S&P. The second support level, down around the 200-day moving average, is just under 4,800. So that'll be the next stop if it doesn't hold. So we see the momentum in the economy starting to slow down, the valuations being high, earnings are going to be tougher to meet in the second half of the year. The technicals are extended, and they need to hold their support levels at this point. What we want to do is be ready to pounce if we get the opportunity, to pounce on things that we really like, some really quality names to keep that durability in our portfolio. So, stock market update. As I mentioned, NVIDIA reports Wednesday. It's a big report for the overall market, expecting 24.6 billion in revenues and $5.59 in earnings. That's 43 times earnings if you analyze those numbers, and 23 times annualized revenues. 23 times annualized revenues. We think that the whispered numbers are 26 billion and higher, and we haven't figured out quite yet all the capital spending that the mega cap technology companies are doing, somewhere around 200 billion in spending. What portion of that does NVIDIA get? But we wouldn't be surprised to see a $30 billion quarter for NVIDIA. That would not surprise us. We think it's interesting. Stanley Druckenmiller, legendary investor. We follow him. We think he's a bright guy. He sold his NVIDIA position, and he bought a big position in small cap companies. So 15% of his portfolio is in small cap. That's a bet. So we think that's an interesting idea. Maybe it's more for the next cycle. If this cycle continues to go, small caps will probably perform pretty well. But we've been waiting to see how this plays out for the economy. We like small caps a lot. We think that's where the next big move for the overall economy is going to be. And we see not tons, but we see a lot of really quality biotechnology stocks. We own really good names in our biotechnology portfolio, but those small cap biotechnology stocks, in our opinion, are really interesting. There's a company that we own. We wanted to buy more, significantly more, stocks in the $3.50 level. I'm not going to tell you who it is, but the chairman just spoke to him about buying a significant piece. He said, Pat, we would not sell it to you even at $5. So roughly a 50% move in the stock. They're not selling stock. So I find that interesting. Now, the CPI report was not positive. The market moved up on it because probably it thought it was going to be worse than expected. But it came in at 3.4% year over year, 0.3% month to month. So that annualizes at about 3.6% month to month. That's higher than the annual rate. So the last 3 months prior to that, inflation numbers came in at roughly 4.5%. So it was good that it did come in line with the previous 3 months, but the inflation rate at 3.4% annually is not good. We'll see if it comes down, but this is what we're concerned about. So this is the April period of last year. We just got the April period for this year. So if you add the 3.4% inflation year over year plus what it did last year at 5%, you're at 8.4% inflation in 2 years. Let me repeat that, 8.4% inflation over 2 years. As we go into the summer months, so this will be the May inflation at 4.9% last year. So we think the inflation rate could probably be around 3.3 or 3.2 year over year. Then it drops. So the June inflation last year was 4%. So if you keep the inflation rate somewhere around that, running at an 8% level on a 2-year basis, that means the inflation rate may pick up as it's reported for June of this year. Then it drops way down. The July of last year was 3%. So the inflation rate, if it stays consistent with where it is, that means the inflation rate could be up over 5%. So the economy is slowing. The inflation rate, just because how the numbers regress, could look higher as we go into the summer months. So the consumer is saying no mas to all these high prices, McDonald's is reacting. You've probably seen that. Target reacted to it as well. We know the consumers balking at the high prices at Starbucks. Lululemon's having problems as well. So the inflation is having is a problem for all consumers at this point, we believe. Credit card debt is high. The savings rate is low. We're seeing, higher charge-offs on credit card debt. The consumer sentiment last week was surprisingly really negative. So we believe that the only way to really kill inflation is with a recession. And our forecast for quite a while now has been, as we enter the second half of this year, that we're going to see a pretty large slowdown in the overall economy. And we're thinking that the positive numbers we may be seeing in the economy this quarter may be related to inventory building, and that the inventory build will have to be depleted in the coming quarters. And with the slow consumer spending, we could have some negative GDP growth. Commodities. So this is what you would expect towards the end of a market cycle, when things are tight, when the economy has grown for a number of years, the capacity utilization rate goes up, and it becomes harder to find things like commodities. So the commodity production becomes tight as well. Copper has been a big winner, so we like to follow copper based on its economic sensitivity. However, we believe that it's more related to supply. So it's the logistics of getting the copper into our country from around the world. And so we think that AI is a large net buyer of copper. However, as I mentioned, we do think it's a supply issue. Now, as you know, we like natural gas. We think natural gas is a way to play increased capacity for utilities to supply artificial intelligence demand. So the artificial intelligence is soaking up all the capacity from the utility companies. So we think to get supply moving, that you simply just divert to using more natural gas. So natural gas has actually, since we mentioned it 2 weeks ago, it's been ripping to the upside. The BOIL that we bought, the 2X on natural gas, it's done extremely well in a very short period of time. So we think that natural gas maybe gets up to $4 on a seasonal basis this year. So at $4, that BOIL has a ways to go still. Oil and copper are the things that we're watching on the commodity side, maybe more so oil, to get a gauge of inflation. So we think as we go into the summer months, we're going to see these really low comparisons again, like we mentioned, and higher oil prices year over year is going to become a problem, or continue to be a problem for oil. Maybe not as we get into the back half of the year, but as we are into the summer months, we think that pushes the inflation rate higher. What we're looking at is it seems to have held this support level here around $78, and it's now trying to break this downtrend line from roughly $87. So it had been trending down. It took the war premium out. And so as the summer driving months pick up, maybe there's a higher demand on oil prices as we enter the summer months, and maybe this can break out a little bit. So this is the chart of the XLE, the energy ETF. It's held the 50-day moving average. So as it holds this, if it can hold it and stay above the 20-day, we're going to go back in. So again, it's trying to break this downtrend line here. So if it could hold it, we think there's a nice trade here into maybe the second half of the year. Stagflation. So bottom line is, if Chairman Powell of the Federal Reserve believes that there is no stag and there's no inflation, that there probably is a slowdown and inflation is going to stick around longer than expected. You can almost guarantee that statement. We say that facetiously, but that's been the track record, right? So as stagflation creeps into the vocabulary of the stock market, that's not going to be a good thing. Higher inflation, slower growth, that's not a good equation for stock prices. So as we said, weed the garden, be opportunistic, buy those things you really like. There's a number of great companies that we have in our portfolios that we'd love to add to if they were down more. We protect our portfolios by using inverse ETFs, by using leveraged ETFs. You should go and look at all the disclosures on these and the prospectuses of these companies just to understand them. However, we think they work really well to hedge portfolios. So if the stock market begins to fall, we can protect our portfolios and then buy those securities, buy those great quality securities that we really like a lot if they should get hit. Thank you very much. Come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. We'll send that to you every week. And if you ever have any questions, just ping us on our website, and we're happy to discuss what we're doing. Take care.